Well, we're less than an hour away from China's release of its second quarter GDP results, and economists we surveyed are tipping for a 7.8% growth on record lending and higher investment, thanks to the government's stimulus measures. The results come out a day after China says its forex reserves topped $2 trillion for the first time. With us for more from Singapore is Daniel So, the regional economist at Forecast Singapore. Good to have you with us, Daniel. China's reserves now close to two-thirds of the size of China's economy, and Blue Gold's Stephen Jen is saying that the reserves are so big because China needs to keep its yuan stable for its exports, so they have to keep buying dollar assets. Do you agree with this view?
I mean, what we can see here is if you look at the shrinking trade surpluses, and I won't rule out a trade deficit for China in 2010 because of the huge rise in import while export remain weak. And if you look at the difficulty in China to draw in foreign direct investment, that means a huge part of this increase in FX reserve actually came from hot money inflow because of the heating up property market, because of the cheap China stocks. So all this, of course, will give China the ammunition to buy US Treasury, and they will hope for a stable or maybe slightly firmer US dollar in the foreseeable future.
Yeah, but that's not going to happen, is it? I mean, many people are talking about whether the Chinese may actually one day dump the U.S. assets because of America's problems. But essentially, China's really forced to sell the yuan to buy these treasuries to keep the yuan from getting any stronger.
In the near term, I don't think China will do that because they may have thought about diversifying away, but it's not in the near term because right now a stable dollar will definitely serve more good than bad to Asian economy, especially China. So, but anyway, if they sell it in terms of the sell down, it will also drive down the dollar and it will also hurt their foreign exchange value. So in the near term, they can't do anything. But I believe that they will try to allocate more of this foreign FX reserve to commodity, to strategic investment in strategic industry overseas, rather than the purely buying US Treasury. But one thing I can see is that because of the correction in trade surplus, this second quarter hot money inflow we may see an increase, but I don't think the incremental increase in FX reserve in China can sustain going down the line.
Yeah, it's got to be bad. You keep saying hot money. I mean, most of the forex reserves were built by hot money. Isn't that a big risk? What if all the money goes out and flows out of China? What's going to happen?
It actually happened in late 2008 when there's signs of huge capital outflow and in the first quarter of 2009. But China is going to control. China has very strong and strict capital control of money out. But I won't see much a hindrance to the stability because of the strict control and because of the partial convertibility of the FX market. So in this kind of environment, China should not face very huge risk in terms of huge surge in outflow.
Now, you know, Daniel, for all the talk coming from China and the other emerging markets for an alternative to the dollar as the world's reserve currency, really, on the face of it, they really have little choice but to keep buying U.S. assets. So how does China break the cycle?
As I mentioned earlier, there's little choice for China as well, because every time you can see that when a Chinese policymaker try to talk about this hypothesis or intellectual debate about shifting away from the dollar, another policymaker will come up to defend the dollar, saying that China have no choice or saying that China would prefer a stable dollar. So all this is showing that China would hope that one day down the line to correct for the international flaw or the flaw in the international financial system to shift away from the over-reliance on the dollar. But right now, they will prefer a stable dollar and a firmer dollar actually because if you look at the China export sector, it is actually suffering due to the huge rise in the real effective exchange rate of China. And after July 2008, the China real effective exchange rate has sort of followed very closely to the movement in the dollar index. So China will be keeping a close watch on this. And because of this, I foresee that there's a tendency, if necessary, for China to actually weaken its currency maybe to 6.84 or 6.845 by the end of this year.
Yeah, you know, Beijing is really preparing the way now for making the yuan an international currency. Daniel, you got selected firms in 5 Chinese cities from July 6 now allowed to use the yuan to settle transactions with businesses in Hong Kong. And the central banks also signed currency swap agreements with the likes of Argentina and Indonesia. So how long is it going to take for the yuan to become this alternative global reserve currency, you think?
Maybe in the next 5 to 10 years. I don't think it's going to be quite fast, but they are definitely inject the necessary ingredient for the yuan to play a bigger international role, certainly. And as I mentioned, it's more of an intellectual debate now, and this some of the more idealistic plan in the future for the Chinese economy.